Hello and welcome to Next Move with Travis and Eric, episode 5. And Eric and I are in beautiful Summerlin, Nevada on location. And we have here Luis Torres in Northern California. Hello, Luis.
Hello.
Beautiful. And
how are you, Travis?
Very good. Thank you for joining us as a guest today. And I'll just, continuing the conversation is that on episode 1, we talked about immutable data and software and hardware and mobile and cloud consensus. And then we moved with Adrian in episode 2, talking about what does tokenized deposits mean. And then we moved with David in episode 3, talking about investment banking, dealer broker, and how efficiencies can be garnered from on-chain services. And then Eugene from Singapore last week, we talked about, and the discussion was great, talking about microfinance and getting out to community lending and so on. And today, I want to look at and propose that we talk about, global trade finance. And, Luis, you have a lot of background, and I know Eric does as well, and there's many different facets to it. But in general, when I look at the market out there, I've seen a lot of companies, maybe 4 or 5 years ago, say that everything they're going to do is on chain. And then you look around at those companies today, and hardly any of them are operating as one cohesive, if you will, network to provide on-chain services and not only manage the documentation, the transactional side of things, but also, and we talked about tokenized deposits, it's actually having in the same environment on-chain is the fiat currency for all the payments, letter credits, and things of that nature. And maybe I'll propose to you, Luis, as the first question is why haven't these companies? They're big vendors. They're backed by Shell Oil and Citibank as investors and so on. What do you think? Were they too early, or what are your thoughts? Being in trade finance and providing lots of money to help stimulate economy with moving trade. Your thoughts?
Yes. So blockchain became mainstream during the 2008 Great Recession. There was, as you all know, there was a lot of leverage in the banks, and that leverage caused the Great Recession. And a solution to that was to create blockchain as a means of trying to solve for the possibility that if the banking system ever fails, there's kind of a backup game. That has been kind of the catalyst that kind of accelerated the process of finding opportunities where the transmission that moves the money around the world, which is liquidity, became a priority for future crises. And the way the government handled that was that in the United States specifically, they created Volcker rule, which limited the amount of capital that banks could lend out based on their deposits. And then the other rules that came about were also Basel I, II, and III, which was more for the European markets. And that was, the Europeans took an approach where they were going to prolong the pain instead of doing it like they did in the United States, where they just say, look, you're going under. So Lehman, Bear Stearns, Merrill Lynch, and everybody just got their heads cut off.
Yeah.
And but the Europeans were able to kind of stay alive, barely, of course, with a rule where the capital requirements were incrementally increasing over the years. And now we're in Basel III, and there is still more assets that they need to sell versus or basically loans that they're giving out that they have to get out of the balance sheet.
No, that's a very, very good assessment on that. And you made a very good point about, so you're saying that maybe blockchain was only used as a backup recordation. Eric, are you spining that? I mean, I've seen a lot of companies out there that's all they do is it's a record to check against later, but it has no real functional operational value in moving and placing money and so on. Would you agree with that assessment?
I like where Louis started. I have two thoughts on it,
Sure.
and I'd like feedback from Louis on it. One is, it is the infrastructure.
Yeah.
You have a distributed ledger. Everyone's gonna be able to find out forensically what's going on, not past tense, right? It's not like when you say Lehman failed, it was sold for $1. I think maybe just recently they've finally unwound everything Lehman was doing. I'm not exaggerating. It took a decade, right? The complexity, the shells of how they put things together and accounted for things, and just to unwind that, it literally was a full-time business for a lot of people.
Wow.
So when you look at the blockchain of the transactions, simplifying it and forensically making sense of it, it bleeds over into the other side, which is into the liquidity. Where is the money coming from? How is it processing? Where is it residing? Odd questions, is it being taxed? Like accountability. You can't really do that in international trade and finance so easily.
Yeah.
And I'm not saying you have to change all the rules, but when you start having money now going into a market, who's managing the market? Who's running the market? How is that going to go? I see a lot of positives from having a blockchain environment that is not solely owned by a Lehman Brothers or another large organization, because that's the other thing. If, as in 2008, as we said, it falls out of the puzzle, you don't have a complete puzzle.
Yeah.
A distributed ledger, as long as the organizations are federated, like we all recognize the nodes in this network, it kind of replaces the old, as we were talking about earlier, trusted node networks. If you people who are over the age of 40 remember SNA server and all the things IBM had, and you know, it was very easy to know who the players were, and then you had the responsibility of the players and how they handle things. Blockchain is slightly different, because you can get to the level of knowing the entities, the registered entities, know your customer, know your business, know the entities responsible in the business. It's a completely different way of accounting for the business transactions.
Well,
But ask Luis if I'm going off on a tangent, if that makes sense to you, is about some of the transformation we can look at here with blockchain.
Absolutely. There is you know, the way I kind of visualize it is that it's a transition, like when we went from mail to email, right? Where the need was always the same, but you know, instead of taking moving money around the world, where it takes, you know, 3 days to 10 days to get your money from one place to another, or any cost of, you know, $100 to move $20 out, that, you know, that inefficiency is really where I believe blockchain, specifically in the international markets, is really shining the most. In addition to serving the liquidity, which is the, you know, reducing the amount of time of moving money from one place to another. That's the biggest cost or opportunity cost that most banks in the trillions of dollars are experiencing. Where, and in particular, global trade finance companies, the speed at which you can transact and settle your payments.
That's you hit a nerve on that one.
So if I can just
very
respond,
critical.
I like what you said. So I want to just have a play on words, but I think it captures what you just said. We always talked about trust but verify. It's been the mantra of finance, especially global finance, for 800 years. Western finance is built on trust but verify. And you trust it, members of your family in other cities and so on, and have those credits, if we still use the term.
Right.
But now with blockchain, you can verify and trust.
Well, it's interesting that, you know, I see it as you have these verification, you know, or you have this information that everyone looks to as the authority, that the area that can be modeled. Because we've had on these discussions, we've had, you know, internal banks have different silos of people and so on, and different retail banking and commercial and this and that. They don't exactly know with great deal of certainty one point of verification or authentic data, in a sense.
And going forward, they don't have to have everything in all blockchains working the same way.
Right.
But every marketplace will have an understanding of who's in the marketplace.
Yeah.
And that's where the verify and trust comes in. And that's a novelty that blockchain brings. And I think that's going to be a big differentiator. And that, as Luis said, is what provides that speed. Just like in a digital form of automating the processes, you can't automate a thing unless you know the origin. And this goes back to our very first conversation with Robert in episode 1, right? You have to
verify,
verify, right? And this plays well into what we talked about with Adrian. And because it's the same thing about where is the money earmarked? Who has the rights to do that? How does it move into the new markets? It's a new, much simpler way of doing it once everyone buys in through a blockchain marketplace.
Well, it dawns on me, and Luis, maybe you could answer this, is that I have seen in financial services, and maybe it applies to global trade, which is not my expertise, is that, you have situations where, well, let's just take a letter of credit, right? And that letter of credit could be irrevocable, could be standby, whatever it might be. It's in between, let's call it 2 banks, maybe some banks that can liquidate that on presentation or certain terms met and the rest of it. But the verification of that is not maybe just the counterparties of the banks, but there's interdependencies all the way through it. Could be the guy in the warehouse that says, "Oh yeah, I've got the merchandise ready to ship," and I mean, it's really interesting.
I'm going to defer Luis. My question actually for him is: it's never just 2 parties.
Oh, that's a good.
You have underwriting of sorts, right? Going on. So
that's a good question. How many parties are out there, Luis?
Yeah. So there are about 30 different standards of letters of credit.
Right. And
many of them are performance driven. So they put conditions in there where the bank can get away with basically not paying. And what usually happens is that when there is a non-performing condition in the call for the letter of credit or getting the cash from the letter of credit, the bank fails to wire the money because of X, Y, or Z. Now, what happens to the global trade finance company is that then they go to the insurance company, and then they claim the money. So the counterparty risk of the bank it fails from time to time. It's a rare event. It's less than 1%. But then for the global trade finance company to fail on that transaction is actually even less than that, because they rely on the insurance that they got for making that transaction take place.
So full circle on earlier conversations we've had about underwriting.
That's right.
You need transparency. You only de-risk from having the ability to this proactive forensics. So the blockchain allows you through smart contracts, because that's really how the marketplaces work, smart contracts. I'm looking at you like you're the audience. Right? You both know this. And I know Luis knows this as well. But the really nice thing is, if you're an underwriter, it's going to bring down the costs, because they're going to say, yeah, to your point, 1% is not a bad failure rate. In a lot of things that banks in real estate and other business lending, that's a very stable and sober, approach. But it does, how do you deal with hiccups? How do you deal with new markets? This gets back into what we talked about with, in Singapore and then in the Far East. We're seeing emerging markets. So how do you help create emerging markets? With these blockchains and smart contracts, with these express terms that you can now use some little AI on and say, oh, look, I want to make sure I understand what are those letters of credit? What are those derivatives that are suspect or, enforceable, and in smaller banks, more problematic, and so on and so forth.
Yeah, well, exactly. When you bring AI, maybe I'll sling back with you, Luis, on this question is that it appears that all this is very manual process, human manual process.
It is. And very, very, very idiosyncratic. So the letter of credit from one bank looks very different from one bank to the other. So, and it's just a very cumbersome process, right? You need lawyers, and you need a lot of red tape.
Yeah, and the interdependencies and so on. And, I look at a world where, we want automation, we love AI and the rest of it. AI brings so much to the world of creating opportunities where, and we goes back to the beginning of all of our conversations, human process and machine process. Nothing's going to replace the human genius and interpretation and instinct to make a call on something. But, maybe the AI presents all the material to consider as a summary to make those instant calls. How does this all come together?
So, but first off, innovation is going to come from the other side. No,
Yeah.
to my knowledge, at this point in time and in the near future, we're not going to see AI form a corporation.
No, no.
Maybe people will incorporate.
You go in ChatGPT, set up a
Right.
company, go call a
When you
lawyer.
start having some chat bot,
Oh, yeah.
creating a company as the CEO, that's a whole different story.
That's
But
right.
we're not there. But the other things I use the term forensics, but this the other thing of humans are flawed.
Well, of course.
So
course.
the positives of creating ideation, all the good things people do, when people make processes, even if they make an error rate that's relatively small, it's never negligible. But when you're talking about things like global trade, global finance, it amplifies. Just takes one or two bad assumptions to kind of ruin the recipe for everybody. AI sees the outliers. It can be easily trained to say, look,
yeah.
here's a new market. Why is it not following the behavior of markets that operate similarly or, that it's modeled after? And now humans will look at that and say, oh yeah, we have to account for that. And that'll be de-risked. They'll be accounting for it and, you might pay a premium for it because there's a justification.
Yes.
And that's where Eugene was talking about. If you start looking at the fruit fly type of world of developing markets in the Far East, there will be some high risk things that you can't do risk. It'll be more explicit. The benefit of reward risk will be figured out in the smart contracts with AI much better than people.
Yes, no, I totally agree. And you said it just top of mind here, Luis, you said that the one of the largest expenses is moving the money. Can you break that down a little bit? We talked about letter of credit, but I mean, it's
Yeah.
is it, hey, we're manually doing a Swift wire and there's all these conditions not met. What's I know the banks on average, their compliance is, accountants and lawyers and so on make up what 30-40% of their operating budget. Is that
Right.
kind of what we're seeing, or what do you think about that?
Yeah. So the biggest inefficiency is your opportunity cost, meaning that the amount of time that it takes to get this done, right? So it could be as quickly as 3 days if you've done it before, but if it's the first time, it could take you months, even a year to get those rails all in place and get the lawyers in place and compliance, and then it keeps running. Now, the beautiful thing about blockchain and doing smart contracts and digitizing this whole process is that it makes it way more efficient. It saves you. It not only that you can save time in setting up the contracts, because there is a continuous process. Every so often you actually have to renew your contracts,
Right.
but also from an execution point of view, if there's a failure, collecting the money from the insurance company versus the bank, you don't have to wait 6 months to get your money. It can happen instantly because everything is set up correctly. Now, here's the challenge of that I see is that banks have a monopoly. They don't like to share their clients' information with other banks. Citibank doesn't like HSBC, right? So there is a lot of private ledgers that don't like to talk to each other. The ISO 2022 is going to help in that process, but I still think we have a long ways to go because they're the incumbents, they're complacent, they're monopolies.
Yeah.
And why would they want to change what they already do? Changes are hard for the incumbents.
I'm so glad that you mentioned ISO 222 because, last time I looked at the report from KPMG that I get, we'll just talk about the US. I mean, even the small banks have T1 ready for the messaging, but is anyone using it? And is these private layers obstructing what was supposed to be this big push by Swift and KPMG and everybody else to get everyone ready to flow the information?
So
we're making more of a problem?
So there's a concept of licensed agent. And these investment institutions will be licensed agent for their investors.
Right.
They have to register their investors for their services, They do that on the private ledgers that Luis was talking about. But now as an agent, I can manage the monies in these different exchanges representing my agency. I will be representing, whatever international bank it is on that marketplace. Remember we talked about KYC? KYC to now register with the agency. That's the stuff that's going to go in the ISO filings. Then you have a different set of transactions on behalf of the agent. So you're going to KYC, KYB. You're going to know who are registered individuals of the agency who are making transactions on the blockchain in the name of the company on behalf of their clients. So there's going to be a two-tier, and then just an idea of tokenization. And Luis got me thinking, when you have that 1% or hopefully lower percentage of failures, it's not just altcoins and stable coins and investment. You create tokens from the smart contracts. So you actually will say, yes, the terms were not met on performance by this transaction, by this bank, and indeed it was a failure to transact. Therefore, they generate a failure token. And now you go to the insurance company and say, this token demonstrates that we've gone through all the terms of the contract.
This is where AI, blockchain, everything kind of meshes all together, and you say, hey, pay up the
It
insurance.
facilitates a process. With
Yes.
the smart contract is the process. The
Yes.
smart contract is the transaction.
Well, beautiful. I mean, it brings up just maybe a top level holistic question is how much does insurance play, either as a cost or benefit? How do we, you mentioned reinsurers and so on for ultimate liabilities. How much do they play in global trade? Is it 10%, 5%? Is it COVID might have been pretty big, right? Everyone, I don't know. What do you think?
Well, the Red Sea, the Houthi, the bombing in the Red Sea, also the Panama Canal when the ship got stuck, and that was kind of held back on global trade finances. These are real commodities that are being transacted, and when that physical cargo gets stuck, or it doesn't get to where it needs to get when it's supposed to get there, it triggers a series of events from a financial perspective, and that's a very low rate. It's still less than 1%. Industry average is about 0.5%. So it's very low, but it does happen, and if you have blockchain instead of the lawyers, instead of these very very complicated rails, then you can still achieve the same thing with a fraction of the time.
Well,
Just
go ahead, please.
You asked an interesting question, kind of the first, what percentage of this, maybe the financial?
Oh, yeah.
It's not so much, it's not a percentage like a dollar value, it's an impact, it's an effect. If you reach a point where the insurers step away, things stop. Period. If you can't define a premium, you can't define a business transaction.
That's true.
Right?
That's very
and
interesting.
that's what was happening, I think, what Luis was saying in the Red Sea. And when you have, a fear of having commerce, well, you can still transact until there's a fear of insuring the commerce. Then you're going to go around South Africa. You're going to look for new routes. And the world
20% expense.
Well, yeah, and
on transportation.
I looked at
additional expense.
Yeah, no, I apologize. We're running out of time. I'm trying to keep these to 15 is my commitment for these. But I will say one thing, maybe in parting, and Luis, thank you so much for being on the show today, is that if you take the AI, you take the blockchain, you take mobile KYC, and you put it all in this, and you go to insurance companies and say, hey, we'll step in and we'll guarantee then we turn the whole thing upside down as a party comment.
Can't guarantee anything.
Okay, all right.
You can disclose, you can make transparent.
Oh, okay, all right.
Which is beautiful music to the ears of insurers and bankers.
Yeah, well, it's a sales guy.
Everybody wins.
All right, Luis, thank you. Have a good evening, and thank you.
Thank you, everybody.
This is a wrap for episode 5. We'll see you next week.
Cheers.
Excellent. Thank you.